Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss managing taxes for multiple streams of income. Specifically, I'm going to chat about how different retirement income sources treat tax withholding, understanding the different tax levers you can pull to optimize income, the progressive tax system here in Canada, when you may be required to make installment payments, how to keep more money in your pocket month to month, and lastly, as always, a few action items for you to consider. Now, for those of you nearing retirement or recently retired, it's important to understand the shift in how you are taxed on a go-forward basis on your sources of retirement income. While you were working, payroll tax was withheld at source from your employer that was then passed along to CRA, and in all likelihood, you received a small refund on a year-to-year basis. Once you enter retirement, however, the burden of proper tax planning falls onto your shoulders. This can be especially tricky to navigate if you have multiple income sources, some of which may not have any tax withheld, and others that may be in a tax bracket over 30%. As a result, many retirees can find themselves in a scenario where they owe tax come April, and in some cases, this number can be significant. To make sense of all this, first let us talk about different sources of retirement income and the tax regime each are exposed to. First, let's discuss the CPP and OAS pensions. When you start these pensions, you are not required to withhold any tax on a monthly basis. Rather, you must make an election through your MyService Canada account and request for voluntary federal income tax to be deducted. Next is pension income from a defined benefit pension plan. In the case of this kind of retirement income, tax is withheld much like when you were salaried. The issue is that the withholding tax is calculated by the pension company as if this is your only source of income. They are not factoring in other incomes like CPP, OAS, investment income from non-registered accounts, RIFs, and more. Now, these other sources of income could then translate into a higher overall taxable income and thus insufficient tax being withheld to pay tax related to your pension. Another source of income to consider is, of course, your RRSP or RIF accounts. With these kinds of withdrawals, tax is applied to the gross amount being withdrawn. Withdrawals under $5,000 attract a 10% withholding. Withdrawals between $5,000 and $15,000, a 20% tax withholding, and withdrawals over $15,000, a 30% withholding tax. So, for example, a retiree withdrawing $2,500 a month from their RIF will see a taxable income for the year of $30,000, assuming this is their only income. Because the annual amount is over $15,000, each withdrawal will attract a 30% tax withholding. This means that this retiree will end up with $1,750 in their jeans each month and will pay a withholding tax of $9,000 for the year. Now, if we assume this $30,000 from your RIF account is your only source of income and you live in, say, Alberta, you most certainly have overpaid tax on the year. Come April the following year, you could receive a near $6,000 tax refund, which to some may sound nice, a tax refund. But the fact is, you overpaid the government with your money you could have been spending or saving yourself. Not good. To complicate things a bit further, RIF accounts themselves are subject to a required minimum withdrawal based on your age. And with these required minimums, there is no required tax withholding, which may give the pensioner a bit of leeway to stick handle their tax payable and decrease the overall tax withholding on their RIF withdrawals. Now, to clarify, no tax withheld on the RIF minimum doesn't mean it's tax-free. You will still owe tax on these monies when you file your tax return. I'll be honest here. I could keep getting deeper into the weeds on this, but I think that is a sufficient amount of information to understand that there is some tax planning and cash flow planning that must be considered as you set up your retirement income stream. Let's shift gears here slightly to give you a better understanding of how taxes work in Canada. We have a progressive tax system, meaning higher levels of incomes are taxed at a higher rate. For example, in Ontario, the first $12,000 or so you earn has no tax. The next roughly $3,000 has 15% tax, and the next $36,000 of income after that is taxed at about 20%. The type of income you earn may change these rates, as well as tax deductions and credits. But if we kept going to higher incomes, there would be an incremental increase in tax rates. If you have a high income, your entire income is not taxed at the higher rate. Incremental tax rates lead to income being taxed at different rates as you move up through the tax brackets. This is why retirees tend to have tax owing. If you have a $10,000 pension, you may have no tax withheld at source. But if you have $60,000 of other income, you might owe 30% tax on that pension income. What this can result in is tax owing on a year-over-year basis. And if you owe more than $3,000 in tax for 2 consecutive years, CRA will start asking you to prepay tax the following year. This is known as quarterly income tax installments. Now, some of you may be okay with managing your taxes and making your quarterly installments to the CRA. However, if you want to minimize these installments or move towards a strategy that gets you closer to a net zero tax refund, meaning you keep more of your dollars in your pocket on a month-to-month basis, then this next part is for you. What you will want to do is get a sense of your annual taxable income from all sources the best you can. Add up that total taxable amount and plug it into a simple tax estimator. This should give you a rough estimate of your total tax payable for the year. Now, keep in mind that many simple tax calculators may not factor in credits, deductions, and income splitting. Now, have a look at your sources of income. If you have RIF withdrawals, you have an automatic minimum withholding that must be withheld. How close is this number to your overall estimated tax bill owing? If you calculate you will still owe money annually, consider requesting additional tax withholding through your employer pension or through your CPP or OAS pensions. Things can get tricky to manage the less tax levers that you have to modify to optimize your cash flow and tax planning. As I said earlier in this podcast, it's pretty easy to get into the weeds quickly when it comes to this level of cash flow and tax planning. And for some, you may just opt to paying the tax man quarterly installments and save the headache. But this is what we do. We are retirement planning specialists who harness every opportunity to optimize your retirement nest egg. Even if it means a few extra $100 a month you could be spending today, rather than giving it to CRA to then give back to you in April. We live in the tax weeds, so you don't have to. Okay, so that'll do it for today. Here are your action items for today's episode. If you're preparing for retirement, get a jump on this tax planning today. Calculate all your sources of income, your expected or required tax payments, and then think about ways to optimize your monthly cash flow. Lastly, if you are retired and have been getting slapped with a tax bill or quarterly installment request, there may be a better way. Check out our FRP process to learn more. Okay, so that'll do it for today's episode. Make sure you add us on all of our socials, LinkedIn and Facebook. If you're enjoying the show, please leave us a 5-star review in your favorite podcast app. Be sure that you're signed up for our weekly Retiring Canada newsletter. And hey, when it comes to retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.